y vamos a hablar en los próximos minutos con Jay Pelosky, que es fundador y principal de TPW Advisory. Jay, thank you so much for being here in Negocios Televisión.
Hi, Martha. Nice to speak with you again.
As we said, earnings season is already here. Today, companies like Johnson & Johnson and Halliburton already reported, but big tech companies like Netflix or IBM will report after the close of trading. What can we expect, Jay, from these two companies, from Netflix and IBM?
Well, I really am not expert on individual company earnings, Martha, so I probably shouldn't comment on what one could expect. I think more broadly, though, in terms of overall earnings expectations, the bar is quite low. JP Morgan and others have noted that the consensus earnings for Q1 are actually 4 or 5% below Q4 earnings, and that's quite unusual. I think it's only happened maybe 5 or 6 times in the last 30 years where quarter over quarter earnings growth is expected to be negative in a growing economy. And it's clear that we're not in a recession given industrial production grew 8% year over year, retail sales strong, et cetera. So I think the bar for earnings is actually quite low, not only in the United States, but also in Europe as well. And so I expect over the next couple of weeks that earnings beats are going to be one of the things that supports equity prices here and in Europe.
Equities behind, I wanted to ask you as well about fixed income market. A few weeks ago, we saw how the yield curve inverted, but now the yield on the 10-year bond is almost at 3%. What happened there?
Yes, exactly. What happened? Interest rates have backed up very aggressively, as you point out. I think the 10-year has backed up roughly 75 basis points over the last month, and the 2-year has backed up 60 basis points over the past month. So there's been a very aggressive repricing of fixed income, and I think it relates to 2 things. One, inflation has clearly been hot, right? The March inflation print was 8.5%, something we haven't seen in the U.S. in decades. And then second, many Fed governors, particularly Governor Bullard, have spoken about the need for the Fed to act aggressively. And even just in the last day or two, Governor Bullard came out and said that a 75 basis point hike might be necessary, though it's not his base case. So I think fixed income markets are lots of sellers, lots of folks worried about inflation, worried about the Fed, and very few buyers. And that's what happens, obviously, when you have a really fast move in one direction. It's an abundance of either buyers or sellers, and in this case, clearly an abundance of sellers. And I think we're pretty much done with this move. I would expect actually a rally in long duration bonds over the next couple of months. I think we've gone quite far in terms of moving almost to 3%.
We just saw that the IMF cut the forecast for economic global growth to 3.6% from previous 4.4% for 2022. Do you think this scenario can finally get worse?
Well, it's clear that with COVID and now with the conflict in the Ukraine with Russia, that we've had an effect on energy prices, on food prices. And so I think there's a natural inclination to reduce growth estimates. I would point out that most consensus growth for Europe, for example, which is the epicenter of the conflict, is still around 3%. I believe JP Morgan and Morgan Stanley, for example, around 2.8 to 3%. And I would just highlight that the 5-year pre-COVID trend growth for Europe was less than 2%. So while the estimates are coming down, the expected growth is still significantly better than it was pre-COVID. And I think this is why the markets are struggling, Marta, because there's a lot of confusion. We also have high nominal growth. So if you put 3% real growth and assume that inflation in Europe is going to be maybe 2% this year, that's 5% nominal growth. And typically, again, pre-COVID, nominal growth in Europe was around 2 to 3%. And I think analysts and investors are struggling to make sense of what it means to invest in a high nominal growth environment. For me, what it means is that earnings are going to be probably better than expected because earnings are determined in nominal euros or nominal dollars. And so I think the earnings bar for Europe and the United States for the full year is quite low.
The Fed meeting is only 2 weeks away, Jay. Is there something Powell can say or something the Fed can do that can actually surprise the market, or is everything already priced in?
I think that's a great question. I think most likely scenarios, namely a 50 basis point hike by the Fed, is already priced in. I mean, given that we're only 2 weeks away, it's unlikely that anything will happen in the next 2 weeks to really change that dynamic. I mean, I guess they could raise 75 basis points. I think that's highly unlikely. They could raise 25 basis points. Likewise, I think it's unlikely. I think they want to kind of get a little bit in front of the market, or maybe kind of show the market that they're aware of the market concerns. Obviously, the Fed has to be focused on the fact that rates have backed up so aggressively in the last month, as we just spoke about. And so my expectation and the market expectation is 50 basis points. And then I think we need to hear a little bit about the quantitative tightening, the reduction of the balance sheet, and the outlook for the next couple of quarters. In my view, we have passed the peak of inflation in the United States. That was in March. In the next several months, due to base effects and also kind of the move away from goods demand to service demand as the economy reopens and COVID ebbs, that we're going to see a fairly significant decline in inflation from that 8% level, probably closer to something to 4 to 5% over the course of the next couple of months and certainly the next quarter or two. And that's going to allow the Fed time to kind of figure out how aggressive it wants to be. And the market has already priced in a very aggressive Fed. So there's room for the market to kind of take comfort from a Fed that's probably not going to have to be as aggressive as what has been priced into markets.
On quantitative tightening, as you say. Jay Pelosky, founder and principal at TPW Advisory. Thank you so much, as always.
Thank you, Marta.